100 mark. So the bell has gone. And the early start is about that 80-point gap down. That's the Nifty for you, down about 0.4%. Mid-cap index is losing a little more than that. It's down about 0.7%. Bank Nifty also down in sync with the Nifty, at least as we speak. Asian Paints, of course, is taking a hard knock. 8% down on the real howler of our second quarter. Dr. Reddy's, Axis Bank, Hindalco. These are some of the early sort of movers on the way down. You have some heavyweight names like Reliance, L&T, which are also dragging. So, well, it's a 0.5% drop now on the Nifty. It is a very cautious start. 120 points gone from the Nifty, and the fight continues around the 24,000 level. Guys.
All right. Well, let's take a look at a few other stocks. Aarti Industries have gone ahead and cut their EBITDA guidance, I think. So that stock is down close to around 6%. Utkarsh SFB, the asset quality issues continue. So that stock, in fact, is down close to around 6%. Premier Energies, well, the numbers look good. The problem is the stock had run a lot. So that's why that stock's down close to around 4.5%. And Indus Towers, there was so much of optimism at around 440 rupees. Now the stock is corrected around 320 rupees. I think in line with what we've seen with Vodafone Idea. That stock as well as half from the top, and that stock is under pressure even today. On the flip side, SCI, that's a stock that's done very well. It's up close to around 8%. Not sure about the news flow on that one, but that's moved well. PFC came out with a set of numbers. It seems the street likes it. They like what they've heard from the brokerages as well. So that one's up close to around 2%. And Biocon, some positive news flow that came in for one of their units. So that stock is up close to around 3.5%. Welspun Corp, the stock has run a lot, but the street has read these numbers. You know, I think the operational performance actually was better than what Phillip Capital was estimating. For the time being, Welspun Corp has opened with a cut, I think, of around 7%. Though from the lows, it's seen a bit of a recovery. It's now down close to around 5%. Second half of the year should be far better. ITI as well is up close to around 2.5%, so some green out there, but the advanced decline ratio is clearly in favor of the number of stocks that are declining, close to around 2:1 as we speak. And a few more names actually that deserve special mention. Oro Pharma up close to 2%. Ashok Leyland, we heard the management earlier today. That stock as well has opened up in the green. On the flip side, oil prices have fallen a little bit, so Oil India is down close to around 2.5%. We're 100 points lower. The reference point on the lows on the downside today is 23,950 on an intraday basis. Reba?
Well, the small cap index is down more than 1%, so there is a lot of pressure. Many earnings reactions. So Advanced Enzymes has opened with a cut of about 7%. Here, profits have declined on a year-on-year basis. Even MapMy India, which is listed as CE Infosystems, this was a company which over the past 2 or 3 years was growing between 30 and 40%. But this quarter, for the last 2 quarters, Q1 and Q2, the top line growth has only been about 13-14%. And the company is talking about a slowdown in the consumer and enterprise business. Autos have done well, but the other part of the business, X of autos has come under pressure. So CE Infosystems straight away 6% gone. Dreamfolks too, down nearly 6% on very large volumes. Jupiter Wagons has reported a drop of close to about 5%. Again, these are all stocks reacting to numbers. Relaxo Footwear. We've seen profits fall by nearly 15% for Relaxo Footwear. Whirlpool too looked okay, but the stock is correcting as we speak in early trade. On the way up, GE Vernova, that's up 5%. Jupiter Lifeline Hospitals. The numbers look good. I think profits went up over here by 50%. So it's having a good start to the trading session, so 4% up on that. Sami Hotels, a stock that Prakash highlighted, as a unique trade, it's a recovery in the hospitality business. So Sami Hotels is up close to about 2 to 3%. But, I think the accident of the day is clearly Asian Paints, 7.5% gone. It's a fresh 52-week low on Asian Paints, and there is no recovery so far. So Asian Paints continues to bleed. On the way up, the top 2 gainers are Maruti Suzuki and Tata Motors.
Yeah, absolutely. I mean, Asian Paints indeed is really pinching this fall in volumes, a huge sort of cut in margins, fall in margins we've seen year on year. So this one continues to take all the negative headlines. Ashok Leyland is now trying to put on some more gain because the management's commentary, as you heard, is very optimistic on the second half, saying that the fleet utilization rates are now going up to 90%. There's more demand for freight. Freight rates have started improving. So they're looking at perhaps hinting at maybe we're at some kind of a bottom for the CV cycle. So Ashok Leyland is a very interesting one. And GE Vernova, Vamakshi highlighted the numbers earlier. They're very solid numbers. And the stock's been up on 5% upper circuit ever since. Trent, by the way, the report that Hormaz was just highlighting, Goldman Sachs saying 8,000 is possible on the stock. Well, 6,347 today. some green on trend.
Well, DCX Systems, they have won an order, so that stock is up close to 5%. Volumes is fairly large for the first few minutes. PPAP Automotive, that's coming as one of the top winners. Volumes not very, very high. Only 50,000 shares have been traded, so that's up 13%. And Vimta Laboratories, that one as well is up close to around 13%. Arius Agro as well, that's another stock out there. Close to 2 lakh shares traded on Arius Agro. The stock is up close to around 10%. Vimta Labs as well, more than 5 lakh shares traded out there. So that's moved up. And SCI is another one with very, very high volumes. It's more than 35 lakh shares just in the first 4 to around 5 minutes odd.
Okay, well, the market's also trying to now pull back from the lows. The cut was about 120 points at the lowest level. Now it's about 86 points. So let's see. It was always the big question of the morning. Will the opening dip be bought? And we'll have more clarity over the next couple of hours. Let's get the conversation going then with our market master of the day, Gautam Trivedi, managing partner at Nepean Capital, is with us. Gautam, thanks so much for joining in. Hope you had a great festive season and enjoyed the rather big eventful week in the markets that we had last week as well. So let's start with India, actually. We'll talk about Trump and tariffs and all of that in a bit. But India, because this is a market that's not used to consolidation anymore, right? Up till September, it was a buy every dip market. Dips were as shallow as 2-3%. But now we've got this 8% fall, and now we're trading in a range. Do you expect more of this ahead?
You know, Subra, you raised a valid question because when the market was going up, nobody complained. Everybody was happy. The media was happy. Investors were happy. Companies were happy, and everything seemed like this party could go on for another 12 to 18 months. But I'm kind of glad in some way that the reality has set in, that there is gravity. And if you look at the way some of these stocks have fallen, especially the mid and small caps, I think it is a wake up to the fact that stocks can correct and the market can correct. But getting back to the real cause of what's causing this correction, I think if you look at the peak of the market, which was on the 26th of September, 216, I think, was the level of Nifty. And, you know, as you said, it's been an 8% correction since on the Nifty itself. But here's the thing. I think, you know, foreigners weren't really that active in the first place year to date in India, if I look at it from January onwards. But they got a perfect reason to actually sell when China suddenly took off. So this was a very sudden move by the Chinese government to revive their economy. They haven't come up with more specifics on what they're exactly going to do. But the fact is that that became suddenly an alternative to India within the EM space. And I think that's when the selling started. Now, to your question specifically on how much more can they sell, let's look at it this way. As of the 26th of September, foreigners owned $1 trillion of India's $5.7 trillion in market cap, roughly about 17%. They've sold about $13 billion, or 1.3% of their total holding on a mark-to-market basis. Can they sell another 0.7? Can they make it 2.5% from 1.3? Quite possible. What can cause that to happen? We've got an earnings slowdown. I mean, it's very evident in the results, so no surprise there. But the reality is that even back home in the US, if you look at the earnings growth for the S&P 500 for calendar 2025, it's as high as 13%. That's the consensus number. So, well, we are looking at 14 to 15% earnings growth for fiscal 26. We have competition from the US back home itself. And of course, don't forget China. China also consensus earnings growth are 12 to 13%. So we still have that, of course. Yeah.
Yeah, Gautam, I want to, sorry to interrupt, but I really want to compliment you because I remember that conversation that you had with us a couple of months back. You'd come to our studios that time and you had just returned from a US trip and you were telling us that it is so red hot. We were talking about room rates, I think, in New York, right? And that's when you kind of flagged off just the sheer power and strength of the US economy. And guys, I just wanted to bring this back to the table because I think even before this became the center narrative of investing more in the home market, Gautam kind of gave us a tip-off because he'd seen it on ground there in New York.
Okay, all right. Good one, Gautam. Hi, Gautam. Good morning and good to see you. Zomato is something that you like, right? I think that's one stock that we have discussed in the past. Now, you have Swiggy, so you have an option out there, and they have come at a sharp discount in comparison to Zomato. What's your view on that IPO, as well as, since Zomato has come off a little bit from the recent peak, your view on the space on the whole?
You know, I think the market's increasingly looking at both of these companies from a quick commerce perspective and how deeply penetrated they can get. Of course, there's a third player, which is Zepto, and then you've got the incumbents like a Reliance Retail, and you've got DMart. And of course, they're getting aggressive, Big Bazaar as well. So I think the competition in the quick commerce space is intensifying, but the market's increasingly looking at both these listed companies as a means of figuring out, again, I'm underlining the word listed companies because the reality is that it's all good when you look at a sector, when you look at stocks within the sector, but what is listed? Which way can a public market investor actually play the sector? And there are only two right now. Well, there was only one, but there's a second one that's getting listed shortly, which is Swiggy. So my view is that quick commerce is here to stay. The next generation, including my two boys, they don't want to walk into a Kirana store and actually buy anything. They haven't been to a Kirana store probably in years. It's just easier for them to place an order, whatever it is they want, whether it's shampoo, whether it's soaps, or something to eat. It's easier to do it through your smartphone versus physically going to a store. So I think both these companies, the future growth is going to come from quick commerce, and that's what I think investors should be focusing on.
Gautam, what is your read of this earnings seasons and the disappointments that we've had so far in Q2? And what does it tell you? Is that expected H2 recovery perhaps not going to play out to the extent that the street is hopeful for? It's going to be a little more deep-rooted in terms of a weakness. And how should one approach stocks like, say, in Asian Paints? It was a darling, it was a big wealth creator. Are we looking at a bottom right now in Asian Paints, or perhaps not?
Yeah, let me answer the first part, which is in terms of earnings growth. I think if you look at, and we've been studying this over the last about 3 to 4 years, but specifically, if I look at the last 3 years and quarterly results within the last 3 years, i.e. starting from the second quarter FY22 to our current quarter FY25. And the data that I have for the current quarter is as of the previous Fridays. Sales growth has gone, i.e. from the second quarter FY22, I'm reading this out directly, sales growth has fallen from 25.7% to 7.6%. EBITDA growth has fallen from 12.9% to 1.2%. And PAT growth has fallen from 38.6% to a negative 5.3%. Again, the caveat is that all of the companies in this current quarter haven't declared results yet, but based on the numbers so far, they're pretty disappointing. So yes, is there a slowdown? I think there's no question about that. Specific to Asian Paints and specific to the paint sector, Asian Paints I think is a great company. 8 days of working capital cycle, which is unheard of in India. I mean, outstanding management. It ticks all the boxes. But guess what? There are at least two big ones, two big industrial houses that have decided to get into the business, which is the Aditya Birla Group and the GSW Group. Deep pockets and are leveraging their existing relationships with cement dealers or steel dealers, as the case may be. And I think there is a business case for both of them to get into this business. So margins going forward, will they come back anytime soon? I doubt it. Of course, raw materials is an important element of margins and profitability, but I don't want to forecast what crude oil is going to be going forward. But the reality is, this space is something that we are currently avoiding.
Okay, that's interesting. Yeah, perhaps we're looking at a structural, downgrading in terms of that margin profile. That's a point well taken, Gautam. So to come back to the point where we started from, right? You were saying that today, I think the S&P 500, you said, right? Or it was the Dow, where average large cap earnings growth in the US is 13%. And then we have our own issues. Some of them we've already discussed. So where does that leave our market? More time correction, more price correction, because you're also not ruling out more selling from FPIs.
Yeah, so, here's the thing. We have a situation where the market for the past, I would say 12 to 15 months has not been driven by fundamentals. It's been driven by fund flows. So the numbers that are coming in month after month, and I haven't seen October's numbers yet unless you guys have, but the numbers that are coming in month after month still suggest that there is zero impact of the FI selling with respect to the flows that are coming in. And I was looking through Angel One's numbers. They've released their monthly numbers. The numbers are staggering. I mean, every month, irrespective of how the market behaves, they've seen a significant jump in net client additions, their average daily traded volume, and overall their funding book for clients. So there's no slowdown on that front, and I think that's something which is going to determine the future course of this market. It's not going to be earnings slowdown. It's not going to be FII selling. It's still going to be driven by the financialization of the Indian equity markets, which is spreading so rapidly that every week, every month, we're adding new first-time equity investors, which is great for the long term. But the fact is, have they seen a correction before? They haven't. And I don't know if this 8% correction is necessarily going to make them think twice.
Okay, all right, Gautam. Always good hearing your thoughts. Thanks a lot for joining in and giving us your take on markets as well as individual stocks and sectors. Well, let's turn our attention to Vedanta. I caught up with the Vedanta management's top brass. I began by asking them about the aluminium cost of production in the past quarter and what's the way ahead. Let's listen in to what they had to tell us.
If you look at our mix, our imported aluminum mix last year, same quarter, used to be around 51%. And we could bring it down to 43% imported aluminum mix. While when the procured OMC bauxite ore used to be 50% same quarter last year, it is also down to 43%. That is more and more we are getting backward integrated with our own alumina. And of course, this is reflecting on the cost. As the quarters go by, I'm sure that we should be able to maintain the same trend and we'll be able to ensure ourselves that we protect our margin in spite of the spiking up of alumina prices.
So you don't see a big spike up in the cost of production on the aluminium side?
No, absolutely.
Okay, all right. So that's the biggest part of the business. So we've got the profitability question out of the way. Let's focus on the debt. You know, the street is always skeptical. What's happening at the listed company entity with regard to the net debt? Now, you've reduced net debt down by close to around 4,000 crores. And as you are mentioning, it's the multi-quarter low. The parent as well is in better shape, and they have deleveraged the books by around $1 billion. Give us an outlook, Mr. Goel. Where does the Vedanta listed company's net debt go from this 56,000 crores? And what about the parent entity?
Sure. Let me start first with the parent company, Vedanta Resources. And you're right, in the current year first half, we have deleveraged the parent company debt by $1 billion. And with that, debt at Vedanta Resources has come down to 4.8 billion, which is almost half what it was almost 2 years ago. So it is at decade lowest debt at Vedanta Resources. At the year beginning, we have committed that VRL debt will go down by 3 billion over 3 years, and we are well on that path. Now coming to Vedanta Limited, the listco, yes, debt in the current quarter has gone down by 4,500 crores. But here we should look at net debt to EBITDA, which is at 1.49x. And in near future, over 2 years, we will go down to 1x. That will be a benchmark in the Indian metals and mining space.
Interesting. The other fear is about the capex plans. You know, you'll have this dream of getting into the semiconductor space as well, and you'll get some support from the government. But what is the total capex spend for the entire entity, since it's still one entity? Could you tell us about that? And how do you plan on funding it? What's the update on semiconductor?
So you may take the capex one, and on the semiconductor, yes, right now nothing beyond what has been already discussed in public. So we'll keep it at that.
But by when should we get a bigger update on the semiconductor front?
Whenever we feel that there is something more to talk about, it will come back.
We'll be waiting by for that. Mr. Goel, you want to comment on the capex?
Yes, on the capex, one can look at a block of 3 years because ours is a long haul industry in terms of capex cycle. So we intend to spend almost 5 billion capex over 3 years. And as you know, in the current fiscal, our guidance is about 1.9 billion and will be in that ballpark. So the 5 billion over the next 3 years, starting with next year, it will be funded all through operating free cash flows. And as you may have seen in the current year, we are reporting a very robust growth in terms of EBITDA and the free cash flows. So the entire capex program, 5 billion, will be funded through operating free cash flows.
So you don't see the debt balloon up from these levels of around 60,000 crores. It should hold in this vicinity?
In fact, the debt both at Vedanta Limited and Vedanta Resources should only keep going down in future.
Got it. Now we have one listed entity, Vedanta, but more the merrier is what the bulls on Vedanta will say. By when do we see the demerger take place? Give us a timeline.
Demerger should unlock substantial value. That is one feedback which is resounding from all the analyst viewpoint. And you may have seen in the last quarter, 2 events, we filed the scheme of demerger with NCLT. And the first stage hearing has taken place in mid-October. And we are quite hopeful and optimistic that demerger will conclude by end of this fiscal.
Okay, got it. What about the sale of the steel plant? There was a, there was this talk that you all are going to be doing it, and you all have spoken about it in the past as well. Get the right value, we'll sell the plant. What is the current update on the steel plant? Are you looking to sell it, or are you looking to add capacity?
On the steel plant, if you say there is a two-track strategy. One, of course, strategic intent. If we can hive off and concentrate on the businesses that we have, but that does not deter us from growing the business altogether. We are almost about to complete our expansion plan at Bokaro. By next year, March, the new projects will be up and running, including the new blast furnace, new coke ovens, everything will be up and running. And then we are also on the drawing board to invest more and expand the steel capacity to 5 million ton in the next stage. So we are not shying away from growth in steel business at all, including our iron ore and value-added business in Goa. While as a strategic intent remains, whenever the situation is right, we get the best value. So of course, we'll have a look at it.
So for the time being, you're focusing more on expanding the business rather than selling it. Is that correct?
Absolutely.
All right. Since we have both of you all with us, Mr. Goel as well as Mr. Mishra, what's the plan with regard to the international zinc business? There was a plan of bringing all the zinc assets under one umbrella. Is that still in the works, or are there any plans of selling the international zinc business?
No, so there are two parts to it. One part was whether merging Hindustan Zinc and Zinc International and make it in one business. That time there was no talk of demerger. Now there is a talk of demerger. So we have strategic organizations. So where this Zinc International falls under Base Metal Group, which is our operations in South Africa. And we will look at that growth of Zinc International under that Base Metal Group. And that growth immediately, they are growing to 1 million ton capacity with new concentrators coming up, mine being expanded. So that will grow on their own. And very fortunate parties, the reserve and resource that they have is slightly more than even what Hindustan Zinc has, and even on a similar comparable grade. So there is no corporate action required right now for merging the two. And whereas Hindustan Zinc in India itself is looking to double its capacity. So the strategy that we had that time, that we will go to 2 million ton capacity by merging the two businesses. Now 2 million ton will come in India and 1 million ton in South Africa. Together it will be 3 million ton. We are creating more value in this new strategic approach.
Got it. All right. What about Vedanta? They surprised everyone. They went and they sold some stake in Hindustan Zinc. And now Mr. Mishra told me, Nigel, I think the OFS is going to happen. And the OFS happened. The government of India came and sold some stake in Hindustan Zinc. Does Vedanta plan on selling more stake in Hindustan Zinc, or for the time being you're done?
See, there are two, government's intention of selling was a committed strategic choice that government had told in the Supreme Court, where government would be divesting their entire stake of 29.5%. So this is just the beginning. Vedanta's choice is depending upon its financial planning, where Ajay Goel would be able to throw light. There is no strategic intent, so to say. We want to run the business, we want to grow the business, and we want to make it, already we are second largest in the world. Of course, we want to make it the largest zinc company in the world. Government's intent is concerned. I had told you the actions will happen sooner than later. They have happened, starting with 2.5%. And the next, what will happen beyond that, we will wait and see.
All right, Mr. Goel, you want to clarify whether Vedanta will sell more stake in Hindustan Zinc?
Say from a capital structuring and the funding viewpoint, with that robust operating free cash flows and recent fundraise through QIP, there is no need for further cash through OFS. But obviously, Vedanta is a large company, and we keep evaluating. Depending upon the interest and the right pricing, we will again evaluate in near future.
Okay, all right. And final question then, does the promoter want to sell any more stake in the listed entity, Vedanta Limited? Mr. Agarwal's in far better shape. Will he sell more stake? Or in fact, if he's in better shape, will he look to buy back some part of what he sold?
Again, in terms of overall structure for the group, our single biggest target of the group remains deleveraging. So be it Vedanta Resources or Vedanta Limited. But again, the prioritization viewpoint, it is the first free cash flows. Any options strategically in terms of a stake dilution, I think can be considered. Nothing on the table. But will you buy more? I think in the current environment, it is less likely, I would say.
But can he sell more?
There's no requirement, Nigel, as you know, but we keep evaluating. Nothing on the table for now is all I can say for now.
Okay, that's Vedanta on the second quarter performance. Plus, of course, a lot of the strategic moves anticipated ahead. Stock right now is a little flat, but the market has recovered very smartly, mind you. Look at the Nifty from the intraday opening gap down of about 100, 110 points. The market's now fighting hard to go in positive territory. The Nifty did turn green also while we're in that conversation. Watch out for a couple of auto stocks. Tata Motors is really revved up. The market is believing what the management is saying about the future. Yeah. Q2 was bad, but management saying for JLR as well as the India business, the second half will be very, very strong. And the market's actually going with that view.
And Sudarshan made this point as well in his top 10 segment. He said the numbers will be weak, but we'll have to see whether or not there's a recovery post that. And that's precisely what's happened. I'll tell you what, we'll slip into a short break, come back. We'll get chatting with the management of Akzo Nobel. Stay with us.
Okay, rounding up close to 9:40, and it's time to get into another corporate conversation. We have the management of Akzo Nobel joining in. The company had actually a pretty decent quarter at a time when biggies like Asian Paints have been sulking under the impact of falling volumes, falling margins. Akzo's performance was actually not that bad. They managed a growth of about 3% at the top line level, and margins were more or less intact as well. Not much pressure over there. We have with us Mr. Rajiv Rajagopal, Chairman and Managing Director at Akzo Nobel, to talk about the performance and the outlook. Mr. Rajagopal, great to have you on. But, you have to allow me this question before we start talking numbers. The entire market wants to know, what is the strategic review of the India business looking like? We've got companies on record. Asian Paints has gone on record to us expressing interest. Berger has gone on record with us saying that, they'd be willing to get into discussions as well. What is the parent saying? And what is the plan for the India business?
So, Surabhi, good morning to you and all your viewers. As far as the strategic review is concerned, what's in public domain is all, to be very honest, even I have as of now, that there is a strategic review of the region that I currently handle, where all options are on the table. At this point of time, the brief that we have is really to run the business, make sure that we continue to outperform. Right. And that's where, me and my management team have really been focused. And I can assure you that, as soon as we have any material information, I would first have to inform my board and all the investors and definitely the medias. But of course, we also need to keep in mind that we have to first also brief our employees. So really no development yet on that. Which is anything material. We continue to perform. As you've seen, the focus has been in the performance in the quarter gone by, and even in the quarter that is right in front of us. So we are right now focused on executing our strategies for the year ahead.
Sure, but sir, is there a time frame to this review? What have you heard from the global parent? By when will some decisions be taken? And also, if you could just tell us, in terms of options, you said all options are on the table. So does that include a complete sale of the India business, partial sale, reorg? What are the options and what's the time frame?
Surabhi, I wish I know. I mean, to be very honest, right now, since it's a very early stage of the review, the scope The exact finalities are all being chalked out. As I told you, as soon as we have any material information, we will ensure that we follow the protocols. We are pretty strong in governance, as you know, and we will make sure that everybody in the chain is briefed. It's, in my view, still a little early. I think this will take time. I have seen the commentary again through media of various players, etc. But from my perspective, I'm like a horse with blinkers, focusing and driving the business, because for us, that's really what sort of matters at this point of time.
Okay, let's address that then. Hi, Rajiv. Good morning, and thanks a lot for joining in. But before we get to the operational performance, is there a possibility that instead of selling out, you all look to buy out some entities?
Nigel, look, I think at this point of time, given the India market cap, buying is, we have to be very careful, because, again, we've got to look at not just the historical performances of the companies, but what lies ahead. So really, what we want to see is really how can we take this brand Dulux and all the brands, to a winning position. The reason we are doing this is because, there is, a couple of new players, and the market is going to get a bit heated. But this is about saying, how can we move this organization and our people to a winning position? I've been sort of in this organization for now more than 12 years. If you look at the performance in the 12 years, we've moved the organization significantly from about 2,400 crores to almost a 4,000 crore company. If you look at our PAC, it was about 150 crores. We are almost now getting close to almost 500 crores. So, but are we happy with what we've achieved? No, the answer is no. I think today, what we want to really do is to really start thinking ahead and planning ahead.
All right, Rajiv, the time you made your big move to Akzo Nobel, I made my move to CNBC-TV18. So neck to neck on that. But let's talk about business then. What is the volume growth you're looking at for the second half of the year? What does it mean for the whole year? And also in this quarter so far, quantify the price hikes, Q3 average in comparison to Q2 average.
Yeah. So firstly, just a quick one on the quarter gone by. See, look, we hit a double-digit growth, volume growth, but there are two parts that sort of dropped the revenue to where it is. One is the price, because at the beginning of the year, as you've heard from all the other peers, there was almost a 3.5% price correction, actually 4%, but there have been slight price increases in July and August to the extent of 1.5%, 2%. So when you net it, it comes to about 3.5%. And then the mix has been slightly adverse because the growth is largely coming in categories like mass, economy, construction, chemicals, and putty. So that's really where the composition is. Not to say that premium is not growing, but the rate of growth of premium is very subdued when you look at the overall average. Now, forecast ahead, look, I would still maintain that our endeavors to continue a double-digit growth across both our paints and coating vertical. And, how is it so far? Look, I think there are a few headwinds still that we saw in the last quarter that is there. But one of the things I must say in the last couple of weeks of Diwali that we really started was a secondary movement was pretty bright, which means that there is some improvement in the market offtake. But still too early. Was it because of the festive? Was it structural? Is something that we need to gauge as we start moving in. By the third week of November, we'll get a good sense of that, Nigel. Yeah. In terms of, the other guidance is, I have always maintained that the industry is going to get a little heated now with new players coming in. And, our guidance has been that we will be in the range that I've always maintained. We endeavor to hold our profitability at this point of time while we continue to focus on growing the business profitably. Our focus is how do we really balance it out between growth and profitability and not really shake one and the other. And that's what really, I must say, the team has done a great job in the last quarter. It is still early days, Nigel. The battle, has just started. So the bugle is just blown. So I think I would like to see how this quarter, next quarter pans across. Of course, by January, the price drops get corrected. So your volume and, your value growths will start coming closer to each other as we move ahead. And we've got very strong plans. We've got very strong plans on our categories, which I can sort of elucidate if you would like me to.
Now, just some more numbers, Rajiv. Hi, Rima here. You said the rate of growth of premium was, fairly poor. What was it in the quarter gone by?
So we were flattish. If you look at the previous 2 quarters, we were growing a pretty high single digit. It was a little flattish. This time, actually, for us, the large towns and mass really outperformed. But it's also remember that mass, we are on a lower base. We've only got about a 1.5–2% market share in mass, as against almost close to a 15 to 16% market share in premium. So remember that contextually. I also believe that these 2 quarters, not just for us, for the industry, we are hitting some high base. So that also needs to be kept in mind. And we've put some very strong plans in place. Rima, if you look at, we've launched what I call a connoisseur product, Dulux Velvet Touch Eterna. We've also launched Dulux Super Clean 3-in-1 Anti-Scuff, right? So we are focusing on how our brand propositions can be more meaningful. How can we strengthen our brand as we move ahead in our decorative paints? Even our coatings vertical has done well. So if you look at our marine and protective and our powder coating business, we've actually done well. We've added capacity. We've just commissioned our new factory of powder in Gwalior, and hopefully that's just started. So to our customers, particularly in the northern region and eastern region, our powder customers, you would start seeing faster delivery times and hopefully a higher growth as we move ahead.
Sure. So just to wrap this up, you're saying that you'll see double-digit volume growth this year, right? That's the first point that you've made. Just tell us, because you've taken some selective price hikes on an annual basis. What is the margin profile of the business going to be like? I think you're around 14% right? I mean, at a margin level, almost 15% actually. So you'll end the year around these levels. Can it get better margin?
I've always said that 13.5 to 14.5 is the sort of range we will, because you've also got the volatility of the crude and the forex also slightly impacting. We actually got a little impacted by higher raw materials last quarter. So even that range sort of that's what we will ensure that we continuously deliver.
Balancing growth and profitability. Thank you, sir, for joining in. Wish you all the very best, and we look forward to the outcome of the strategic review. Now let's move on and talk about Info Edge. Now, Info Edge has also clocked in a pretty good quarter. There is a recovery in the Naukri business. Billings in Naukri have now hit 14% as IT hiring is showing signs of a pickup. Chintan Thakkar, whole-time director and CFO at Info Edge, is now with us on the show. Mr. Thakkar, thank you for joining in. Let's talk about Naukri business, because your billings growth in the Naukri business was subdued over the last few quarters, and this quarter it's seen a double-digit growth. Can you sustain this kind, and what is happening on the IT hiring front? Has it bottomed out? Are we seeing a pickup?
Yeah, no. So you are very right. Because if you look at last 4 or 5 quarters, we have been kind of gradually growing up. And in my past commentary, we have been saying that, look, I think it looks like that we are out of the U-shaped recovery and we are going on the upside of it. Right? And this quarter kind of proves us right in that sense that now we are continuing on the path of growth. And more interestingly, it's just not about the headline number that you talked about, but when we slice and dice the numbers and when we look at it, every segment and every sector, whether it's metro cities or tier 2 cities, whether it's IT or it's non-IT, whether it's consultant, large clients, small clients, we look at all this slice and dice, and I think our confidence is kind of much more than what it was when you look at the last year numbers. So we are really hopeful that this trend will continue. And the second part of your question on the IT hiring, yes, we are looking at the IT hiring also kind of gradually coming up. But still, the non-IT is a kind of bit more than what IT is, which in a way is good also for us, that it kind of we are no matter whether it's tech or non-tech, our platform seems to be working very well. But yes, IT hiring is certainly kind of also slightly on the up.
I think non-IT hiring segment grew 20%, while the IT segment grew 12%. Is that correct, Mr. Thakkar?
Yeah, that's
in
correct.
The quarter gone by. Okay, so for the full year, can we get double-digit billings? Last year it was flattish. So for this year, do you think it's possible?
Yeah, no. If you really look at the past trends and the commentary that I've just given about that it looks like that the things are kind of improving quarter after quarter, then we can really kind of expect that. Look, even if you look at last, let's say 10 years CAGR, we would be in the recruitment business would be something around at least 15% kind of CAGR. So I think that's the zone in which we have played in the past, and we are hoping that at least we would go. In fact, we would target even more than that, but let's see how it goes. Particularly the last quarter of the year is very, very critical for us. But I must also add here to say that, look, certainly the job market has given a trigger for the growth, but it is just I think the growth rate is much higher than what the trigger is, and that's because of the superior execution from our sales team, marketing team, product team. I think so. There is a delta growth that we are getting also because of superior execution that we have. So keeping both the factors in mind, the execution as well as the recovery in the IT market and non-IT kind of continue to go stronger. We would, it would not be unreasonable to expect that.
Unreasonable to get back to the double-digit billings growth that we've historically seen. Historically, it's been 15%, but at least double-digit for this year is not unreasonable to expect now with the recovery in IT and continued strength in non-IT. What percentage of your Naukri revenues comes in from non-IT?
So if you look at direct, from IT is something around, let's look at the consultant, and we divide because consultant, we don't know who the real customers are, the growth, the IT as well as the non-IT, right? But if you really take it with certain assumption around that, we would think that non-IT should be around, maybe 45%, maybe 50% type of, share in the overall revenue.
Okay. And you want to further increase the contribution of non-IT. So from current 45-50%, you would like to scale it up to what number, sir?
Look, we are at a certain scale that whatever is happening outside in the economy, that gets mirrored on platform. So I think it also depends on what the external reality is, which would get reflected on our platform. Right? But as a strategy, we are, expanding our branches in the tier 2, tier 3 town as well. And that's also getting a kind of an additional delta of growth for us. So we really don't have any percentage in mind. If IT again suddenly starts booming well, maybe IT will, will again start.
So when will you
has been
expand
has been growing, and it's a reflection of what's happening in the economy.
Yeah, you spoke about the strategic decision taken by the company to expand into tier 2, tier 3 cities also. I think the goal is to hit 100 cities from the current 70, your presence. When will we hit 100 cities? Is it 1 year, 2 years away, or even longer?
Look, last 15 to 18 months, we have already increased our, our strength in the tier 2 towns and tier 3 towns. Right now, we will kind of wait for the results to come, and certainly we are seeing some early results in some of those places where we have opened the new branches. But we would wait for it, and then maybe in Q4 and maybe Q1 next year, we would probably look for another round of expansion.
Okay. Mr. Thakkar, hi, good listening in to you. Let's also now put the spotlight on the other businesses. Let's talk about 99 acres. Let's talk about Jeevan Sathi as well. On 99 acres, you've done, I believe, revenue of about 102, and the margins is at 17%. The profit before tax, I mean, that's still minus 14%. So what is the game plan for 99 acres in terms of better profitability, and also throw in a word on the Jeevan Sathi business as well? What about reducing the cash burn and the losses there?
Yeah. So if you look at the billing number and look at the expenses, because revenue is a lag, effect on that, But if you look at that, we are reducing the losses in terms of absolute amount. They are not, really very high. And we are hopeful that by Q4 we will have a run rate of break-even. So it should be a bit neutral by Q4. That's our expectation. But let's see how it goes, and it also depends on how competition is playing as well. Jeevan Sathi has been, the past 2 quarters has been growing 30% plus. So that's a very encouraging story. Whatever the new strategy that we adopted seems to be working out for us, and that's already almost EBITDA neutral. So that also we think that for the year, unless we change the strategy and start spending more.
No, Mr. Thakkar.
Yeah.
Sorry. Just to clarify, you said break even for 99 acres in this year. That's at the EBITDA level or the net profit level?
No, at the EBITDA level, there isn't much difference for us, EBITDA and PBT, because there's no real borrowing for us.
So EBITDA break even for 99 acres in this year by
Q4? The run rate basis in Q4 is something which we would hope for, right?
Yes.
Because in absolute amount, the losses are not very high.
Sure, and for Jeevan Sathi? Yeah.
It's almost already, even if you look at Q1, Q2, I think, this quarter, cash basis, I think it's about 1 crore or 2 crore kind of losses. So I think it's negligible. So we are hopeful that even that. So Jeevan Sathi could be even for a full year, unless, as I said, that we start spending more on the marketing side. we can expect that. So on the current strategy, it should be the case. While 99 acre, we hope that by Q4, there are some certain initiatives that we have taken. We hope that it will kind of start producing more results by the Q4 end. So let's see how the Q4 goes for 99 acre. But that's the target.
Okay, we'll leave it at that. Thank you very much for joining in. By the way, in the green now for the benchmark indices, the Nifty's recovered a full 150 points from the day's low. Mitesh is now back with us. Mitesh, what have you made of this and what would the calls be at 10 a.m.?
So, good morning. I was in fact talking about this, that the PCR is extremely oversold and 24,000 could be an area from where we could bounce back. We got a low right there. We've kind of taken some, not fully, but partial long positions on the index, believing that today's low will hold. And there's a good chance that we might see 24,000 and about 250 to begin with on this spot, and possibly in a good case a retest of the highs which the index made on Wednesday last week, which is around 24,450 to about 24,500 zone. So I think those are the targets from the upside. So trading with a marginal long bias, and as long as today's lows don't get taken out, I think we'll maintain this stance.
Okay, Mitesh, before we get to your picks, and good on that call this morning, you said you could look at being adventurous and buying into it. What's the call on Reliance Industries? Because that one's still down close to 100%, and it could be the swing factor for the day, given that HDFC Bank has now stabilized. Call on Reliance and your picks as well.
True, I think Reliance is extremely oversold, but I still haven't got a sign of reversal. Maybe if once we see the stock get past today's high of 1280.82, it should give a corrective rally to about 1300, and beyond that, I think some kind of an up move could start to about 1340, 1350 odd levels. But what is looking strong is the IT patch. I have a buy on HCL Tech with a stop at about 1840 for targets in excess of 1900 here. And the other one which I like is the Tech Mahindra, which I would recommend buying with a stop below 1679 and a target of around 1740.
Okay, thank you very much for that. On your screens are the visuals of the swearing-in ceremony of India's 51st Chief Justice of India, Mr. Sanjeev Khanna. He takes charge from Mr. Chandrachud, who had retired over the weekend. Prestigious post, and Mr. Sanjeev Khanna is now taking his oath. Okay, Mr. Khanna will be succeeding Justice Chandrachud, who retired on Sunday, and his term will last till 13th of May 2025. The President, Ms. Murmu, will be administering the oath of office at the Rashtrapati Bhavan. The national anthem has just been sung. We all stood up here in respect to. That's a big change of guard.
Yeah. So Justice Sanjeev Khanna is the second senior most judge of the Supreme Court. He started his legal journey in 1983. He was with the Delhi Bar Council, and of course, through the many decades in the legal system, now he takes over as the 51st Chief Justice of India. He has had experience and, of course, expertise. His expertise goes into taxation, arbitration, commercial law, environmental law, some of the many aspects which he has looked at very, very closely through his legal career.
Okay, we will slip into a very short break on that note. On the other side, we'll put the focus on commodities. Manisha Gupta will join in next.
Welcome back. So there's been some recovery in the equity market. The markets are well off the lows, and the Nifty has pulled back a whole 100 points. Let's now shift the focus to the commodity markets and find out what's the latest. We have Manisha with us. Manisha, so what's catching your attention this morning?
You know, while most commodities are consolidating, catching their breath, there are a couple of things that have continued to run. One is Bitcoin at all-time highs at above 81,000. And the other is the report that FAO put out over the weekend telling you that the world food prices have surged to the highest level in 18 months in the month of October. If you look at the index numbers itself, it has gained up by 2% on a month-on-month basis. It's up 5.5% on an year-on-year basis as well. And this big jump that we've seen in the food price index globally, much of that really comes in because of the vegetable oil index, which has gained up by 7.3%. It is trading at a 2-year highs. And within vegetable oils itself, we have seen almost everything rally in the global markets there. If you look at the palm oil prices, well, they are trading at 2.5-year highs. Soybean prices, sunflower, rapeseed also are trading at a multi-month highs. The other thing to watch into the index is the cereal prices, which also have surged up by nearly a percentage point on a month-on-month basis. Here as well, when you look at the global cereal production for the year 2024, well, that is projected to decline slightly. It's going to be a second highest on the record even then. But within the space as well, the global wheat prices have surged. That is because of the adverse weather and also because of Russia is now putting up a very strong floor in sense of prices. Maize is also something that has been on the stronger side. It's fuel demand, food demand, also feed demand is what is keeping these prices on the higher side as well. What also has done quite well in the markets is the sugar prices. Brazil, lower production, and of course the US use within biofuel has been supportive this price. So 2.5% of gains into this one as well on a month-on-month basis. Dairy has been another thing, 1%, 1.9% up on a month-on-month basis onto this one as well, and 21% up on year-on-year basis. So these are the food categories within the overall food index which have performed quite on the higher side in sense of prices. I also want to take you to the final slot which tells you on how the prices have been in the last 1 month itself. As you can see, it all belongs to the edible oil price gains. Palm oil prices gained up by 18% in the last 1 month, and you have seen 7 to 10% of gains come in for rapeseed, sunflower. Soybean was up 3% as well. And then apart from that, corn has done well, 5% of jump upon that, and that is when we stop. Everything else in sense of food prices actually have seen a bit of a easing coming in. So whether it's about sugar and cotton, 2% of decline there, 4.5% of cut coming in for rice as India starts to export. And then you have tea prices declining 5%. Cocoa came off by 8% in the previous month as well. And we've seen coffee prices quite flat. For this week now, it really is going to be about a dollar index, which is back around 105. That is something that the street will watch out for. You also have the US inflation numbers coming in this week. And then there is Powell testimony on Thursday. That would give you further directions for this week.
Okay, all right. Got that, Manisha. Thanks very good. Thanks very much. The good news being that there's some cool off in cocoa, tea and coffee. At least it's not surging any longer. Thank you for joining in with that. We'll take a quick break on that note, come back on the other side. And actually, before we take a break and get to our next special segment, we have Mangalam joining in. So let's quickly go back and revisit Asian Paints, because while the rest of the market has recovered, Asian Paints, I think, is still under pressure. Let's pull up the stock. Yeah, it'll come up on our screens in just a bit. The color has been red this quarter. Mangalam.
It has been red, and how? It's one of the biggest intraday losses that we've seen in Asian Paints, down about 8% when I last checked as well, and for good reason. You know, if you look at the numbers, 5.3% revenue decline that the company's posted. It's lower than every other paint company that has reported so far. We thought, you know, Kansai would be weak, Berger would be weak, Akzo Nobel and Indigo Paints were slower, but Asian Paints went ahead and surprised everyone on the downside with a negative revenue growth, and not just a negative revenue growth, a negative volume growth, a decline of 0.5%. Ex-COVID, it's actually one of the first declines that the company's posted in over 12 years or 48 quarters. So that's a negative, and that's percolated all the way down to the bottom line as well, with the margins compressing almost 500 basis points, the net profit falling about 44% as well. What is it that led to the miss? The company attributes that to weak consumer sentiment, persistent rains and floods in some part of the country. Also, the international business was impacted by weakness in Ethiopia and Bangladesh. The net profit was impacted by a couple of exceptionals, 124 crore impairment of investment in White Tea Co. and 56 crore forex loss in Ethiopia. The important thing to track, however, how much of that perhaps could be competition? Because if you look at the management commentary, you know, the company has alluded to increased rebates and increased sales expenses twice. Does that mean that they are giving a lot more to dealers to push their product and that's impacting their overall margins? That is something we'll have to watch out for. Employee expenses too, as a percentage of sales, have increased by 13.5%. As a proportion of sales are up by almost 140 basis points. That's impacting their margins as well. So when you pay a little more margin to dealers and a little more to your employees, Is that because of competition? That's something we'll watch out for. The company is expecting margins to recover, but demand conditions are still a little, subdued. The stock, with today's decline, has gone back to May 2021 levels. It's fallen almost 30% from its 52-week high, trading at around 45 times. The two key questions that everyone will want to know the answer to. One, will things recover for Asian Paints from here on? Or second, is there room for further derating after this big decline?
Well, the heightened competition, perhaps there are no easy, clear answers immediately, which is why that stock is still down 8%. Maglam, thank you very much for that. We'll take a break. On the other side, our special segment, It's the Economy, coming up. Lata today will be in conversation with S&P Global Ratings, as well as experts from Goldman Sachs to talk about the underwhelming Chinese stimulus package announcement.
Hello, Mr. Shan. Yeah, Mr. Hui Shan.
Yeah, I'm here.
Am I pronouncing your name correctly? Hui Shan?
Yes, very good, actually.
All right, thank you. Thank you, Hui.
Yeah. No problem.
Welcome to It's the Economy. China's National People's Congress on Friday announced an additional 10 trillion renminbi support to its local governments for debt resolution mainly. But the government did not announce any details on bank recapitalization or on other consumption support steps that were expected. And then, of course, there is the big overhang of tariffs from the United States. To get a comprehensive perspective of the Chinese and US policy steps and its implications for the rest of Asia, I have with me Louis Quiz, the Chief Economist, Asia Pacific at S&P Global Ratings, and Hui Shan, the Chief China Economist at Goldman Sachs. Hui and Louis, thank you very much indeed for joining me. Well, let me start with you, Hui. Your first impression appears to be that, I read your report, appears to be that you find the steps underwhelming. You don't expect too much of a China recovery on the steps announced up until November 8th?
That's not entirely correct.
Okay.
The MPC readout came out, and we got a lot of client questions. Is it a 6 trillion package? Is it 10 trillion? Is it 12 trillion? A lot of confusion. And our bottom line is that it's largely in line with our expectations. The reason why is that if you look at the debt resolution plan, the 10 trillion package you mentioned, that's larger than our market expectation going into Friday, which was 6 trillion. On the other hand, also as you said, they didn't announce the central government special bond used to be used for bank recapitalization or consumption boosting. So that was disappointing to investors. However, we looked at the press conference after MPC, and they did say these are being discussed and this will come out, just not right now. So all in all, we think is in line with our expectations. We think that China's easing measures will continue. This will not be the end of the stimulus.
Okay. Louis, to you, when we last spoke after their previous stimulus package, you weren't all that satisfied or optimistic about the recovery. You know, Reuters and Bloomberg and even Caxton keep reporting that there is a likely income transfer. We didn't see any steps this time or last. What is your expectation in terms of any income transfer to the bottom of the pyramid? Nothing much has happened?
Yeah, hi, Lata. So, so we've seen a range of measures. And as Hui said, we expect that it's going to be good for confidence, it's going to help with growth. It's not a game changer. And in those areas like more government support for households, for consumption, we haven't yet seen much. We will be waiting to see what comes in, around December in terms of the policy discussions as to what they are planning to do for 2025. Okay. But so far, it's not a game changer. It's positive for growth, but in the context of that likely U.S. action, this is not going to be a game changer for growth in China.
Okay, then let me discuss that game-changing fear. It's quite possible that China did not announce a package because they perhaps want to see what the U.S. will do. Now, what is your expectation? I was looking at the top imports of the United States. The biggest import is machinery, and then vehicles, and then minerals, fuels and oil, pharmaceuticals. I mean, can you make all this like 10 to 60% more expensive? Can you really do that and without hurting yourself? So what's the realistic expectation in terms of U.S. response?
Well, I'm happy to go. Please, please,
go ahead, Louis.
No, you go.
Okay.
Yeah, okay, to you.
Okay. So if you look at the U.S. imports and China's share in total U.S. imports is less than 15%. Yes. So our baseline going into next year is that U.S. will increase tariffs on China by 20% effectively, not the 60%, but 20%. If a 20% effective tariff rate increase, and our U.S. economists estimate that impact on U.S. inflation, CPI, would be something like 30 basis points. So it's sizable, but it's not huge. So for that reason, we think 60% might be tough, but 20% seems like a likely outcome. That's our baseline heading into next year.
Louis, what's your take? Do you think this is reasonable? Because, I mean, you can't make pharmaceuticals and oils and minerals and fuels expensive by such a measure.
I see your point. Like, to what extent, is this a good idea for the U.S.? I think we are kind of beyond that discussion, right? It kind of looks like they really want to do that. And there are people in the Trump team who are quite aware that this is going to be challenging also for the US. As Hui said, it's going to be inflationary. In our view, it's also going to reduce growth. So from a macroeconomic point of view, it doesn't always look like a terrifically good idea. But if there is enough political willingness to do this, then they will push ahead. We also don't think that they will very soon lift these tariffs to the full 60% on all of the goods from China, because it depends a lot on the types of goods, and there will be a lot of lobbying and scrutinizing over these different types of goods. But it does look like they want to move ahead on this.
Okay. At the moment, Louis, are you reducing either global growth estimates for 2025 calendar or Chinese growth, or Are you reducing growth estimates for anybody, or even increasing, for that matter, for the US?
Yeah, so, well, on the good, we are actually right now in a new forecasting round, and we'll be looking at all of the